Hello traders, and welcome back to another video. A lot of traders uses the lagging as well as leading indicators in their trading plan. Generally, most of the traders prefer to use the leading indicators as they provides the signals before the price makes the movement. The ones who use the lagging indicators often make losses or small profits as these indicators provides the signals too late. So, what's the solution of it? In order to resolve this issue, we have to use the technical tools along with the lagging indicators. And hence, we would discuss about one of the lagging indicator in this video, which is the MACD indicator. The MACD, or Moving Average Convergence Divergence, is an indicator which helps in measuring the strength of the trend, but the MACD indicator provides fake signals also at times. Like in this chart, we can clearly see that the market is in an uptrend, but the MACD indicator is giving sell signals to us. Now, what can we do in a situation like this? The steps that we should take in situations like this are discussed in the second strategy of this video, so make sure to stick around the end. Now, before we move on into the video, if this is what that interests you, then like the video and be sure to subscribe the channel so that you don't miss out our upcoming videos. Let us first begin with the basics of the MACD indicator, and after that we would share two advanced strategies. The MACD indicator consists of three things: the macdline, the signal line, and the histogram. The MACD line is calculated by deducting 12-period EMA from the 26-period EMA. The signal line is nothing but the 9-period EMA line, and this is called the histogram. The MACD line and the signal life affects the color of the histogram. When the MACD line crosses above the signal line, the histogram turns green. And likewise, when the MACD line crosses below the signal line, the color of the histogram turns red. And similarly, the MACD line and the signal line has a huge impact on the size of the histogram too. During the consolidation phase, the MACD line and the signal line is closer to each other. And due to this, the size of the histogram has become smaller. And similarly, when the MACD line crosses above or below the signal line with a huge gap between them, the size of the histogram becomes bigger, and this indicates that there is strong momentum into the market currently. Now let us see how the strength of the trend can be identified with the MACD indicator. So, here we have the chart of the market where the price is making higher highs and higher low. As there was a huge gap between the MACD line and the signal line, the size of histogram became bigger. This indicates that there is a strong bullish momentum into the market currently. After that, the uptrend started to weaken, which can be clearly identified by looking at the histogram. The size of the histogram started to become smaller, which indicates that the current market trend is weakening. And a new trend may start very soon. And hence, the traders should start booking the profit at this point. The commonly used way of the MACD is to go long when the MACD line crosses above the signal line. And likewise, when the MACD line crosses below the signal line, we should go short into the market. Let us use this way on the chart and check whether using this would make us profits or not. So here we have the chart of the market where the price is making higher highs and higher lows, which clearly indicates a market being in an uptrend. As the market is in an uptrend, we would find the areas from which we can go long. The MACD line has made a crossover above the signal line, and thus we would go long from this point. The stop loss is placed below this recent low, and the target of our trade is kept at 3 times the stop loss. Let's wait and see the result of our trade. The market went below, and hence we made loss from our trade. Let us see this chart on the higher time frame and see where we made a mistake. So, at the higher time frame, we can clearly see that the market is in the downtrend phase, and the upside movement that we saw at the lower was just a pullback into the higher time frame. The trade which we took was against the trend, and because of that, we ended up making loss from it. And hence we recommend you to use the MACD indicator along with the other technical tools. There's an important thing about the MACD indicator that you must know. When the MACD line and the signal line are closer to each other, and the histogram has also become smaller, we should avoid going long or short into the market at that time. This is because the market would be in the consolidation phase when the MACD reacts like this. And taking trades during the consolidation phase is risky and can lead to loss at times. Now that we have learned about the basics, let us move to the strategy. The first strategy of the MACD indicator is to trade with the divergences. Before we dive deep into the strategy, let us first understand what are divergences.
The divergence means that the price and the histogram are going in the opposite direction rather than going into the same direction.
The divergences signals that the current market trend is weakening and the new trend may start very soon. Let us now move over to the strategy. Let us learn the strategy through an example. So here we have the chart of the market where it is making lower highs and lower lows.
And now the current trend, which is bearish, is seen weakening. This is because the price is making smaller impulsive moves, and also the size of the histogram is getting smaller.
The price is making lower lows, but the histogram is making higher lows. This is what is called the bullish divergence. After seeing this, we would wait for the market to make some bullish candles. The market has started going above, and thus we would go long into the market from this point. The stop loss would remain below the low of this candle, and the target of our trade would be 3 times the stop loss. The market continued going above, which is why we made great profits from our trade. Now let us see one more example of this strategy so that you can understand it properly. So here we have a chart of the market where it is making higher highs and higher lows. This indicates of market being in an uptrend. The market has made a corrective move recently.
Now from this level, the market can go at any point. On the MACD indicator, the size of the histogram started to become small as compared to the previous ones.
This smaller size of histogram clearly indicates that the buyers have become weak and the sellers are trying to be dominant into the market. Now let us wait for the market to make some movement to upside or to the downside. At this point, there is one more thing that you might have noticed. The market is making higher highs here, but the histogram is making lower highs.
This is called the bearish divergence.
This clearly signals that the strength of the current trend, which is bullish, is weakening, and a new trend may start very soon. But we would not go short just by seeing this into the chart. And instead, we would wait for the market to make some bearish candles for the confirmation. For getting the confirmation and then taking entry, we would switch on to the lower time frame. So, at the lower time frame, the market started making some bearish candles, which is why we would go short from this point. The stop loss of our trade would remain below this candle's high, and the target will be 3 times the stop loss. The market continued making downside movement, which is why we made great profits from our trade. Using the divergences alone into the trading plan can be risky. This is because the market does not make a reversal every time after the divergences occurs into the market. And hence we recommend you to use the multi-time frame analysis along with the divergences so that you get saved from making losses into the market. Now that we have discussed the first strategy, let us move to the second strategy.
This strategy would resolve the issue of the fake signals which are being provided by the MACD indicator. So in this strategy, we would use the 21-period EMA and the 100-period EMA line, along with other technical tools. The 21-period EMA provides dynamic support and resistance to the price during the bullish and the bearish phase of the market. Now, before we begin with the strategy, let me tell you this, that this strategy only works during the trending phase and not during the ranging phase. Now, let's understand this strategy with an example.
So in this chart, we can see market making higher highs and higher lows.
And also the price is above these 2 EMA lines, which indicates that the market is in an uptrend.
As the market is in the bullish phase, we would find out areas from which we can go long. For going long into the bullish trending market, we should enter into the market during the corrective move. The market has started making the corrective move. We can see that the market has broke this resistance zone previously and now is coming back to it.
The price started going above from this level, but we not take entry here, and instead of that, we would wait for the price to go above the 21-period EMA line. The price has finally gone above the 21 EMA line, and also the MACD line has made a crossover above the signal line. Now is when we would go long.
The stop loss would be placed below this candle's low, and the target of our trade would be 3 times the stop loss. Let's see what happens next. The market started going above, and hence, we made nice profits from the market. This brings us to the end of this video. So in this video, we shared the best and effective MACD indicator strategy that would help you in increasing the profits from your trade. But we suggest you to backtest this strategy before using out in your trading plan. Now, before we end the video, if you found our content valuable, then hit the like button and be sure to subscribe to the channel so that you don't miss out any of our upcoming videos.